What's going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. So today I want to talk about 5 ways which you can profit from a bear market. I'm sure everybody's going crazy looking at the Dow Jones Industrial Average, the S&P 500. Oh no, what are happening to my investments? They've dropped nearly 30% in the past month due to the coronavirus, due to the ongoing price wars on oil with Saudi Arabia and Russia. There's really a lot going on in the market. The Fed's cut interest rates to zero. There's tons of things going on, and what I want to specifically talk to you about today is 5 actionable concepts which you can profit from a bear market. Okay, so let's go ahead and jump into it. So first things first, what is a bear market? A bear market consists of a prolonged period of stocks trading roughly 20% below their previous highs. There's often widespread pessimism and negativity which occurs over these prolonged periods, and it's self-sustaining over time. So when stocks fall, it's kind of hard to know when they've reached their bottom. If you wait too long, stocks might recover and you've missed the opportunity to buy a dip. But if you're too quick to pull the trigger, you might see your stock continue to decline and you've pulled the trigger way too quickly.
That's not a good thing.
It's often tricky to identify when to time the market, which is why most seasoned investors actually advise against timing the market. Okay, so now that you know what a bear market is, let's get into the 5 ways you can profit from them. Okay, so the first option is derivatives, also known specifically as options, and the specific option you're looking for is the put. Now I'm sure you're asking, what is an option? What is a put? So a derivative is a contract between 2 or more parties whose value is based on the underlying asset. Common instruments which are used for options, or just derivatives, are bonds, stocks, interest rates, indexes, etc. You can basically trade the option to buy or sell the underlying asset. And that's where we get into call and puts. A call option is the option to buy a security at a predefined price within a specified period of time. And a call buyer will profit when the price appreciates of that specific security. So you have a strike price, which is your option to buy it at that price. There's a finite time which you have the right to exercise that option. So if we're looking at the board here, your payout will look something like this. Okay, so what we have here is the value in dollars, and then we have the time period over here. As an example, let's say you buy a call option that expires in 3 months to exercise the Apple stock at, let's say, $102. And currently it's trading at $100. Okay, so $100 current value, strike price 102. If the value before the end of those 3 months goes up to $110, you have the option to buy that stock at 102. So you're profiting $8 between the current price and the strike price. There's also put options, which is the option to sell at a given price. So your payoff looks a little bit different. Let me just give me a second here. Okay, now put options are the exact opposite of a call option. Put options are the right but not the obligation to sell at a given price. So what that means is, if we're using the same example of the Apple stock, if you buy a put or you sell short a put to sell Apple at $100, meaning your strike price is $100 and it depreciates to $90, well, you still have the option to sell that stock at $100. Now, there's transaction costs associated with these options, so it might cost you $5 for that put of $100, and then your payout is then the difference in market price minus the transaction cost. So derivatives are kind of used for 2 main reasons: to hedge or to mitigate your risk, or to reward yourselves for speculation. Okay, so a lot of the times you see farmers will go into these futures contracts to sell, or forward contracts to sell a given commodity at a certain price, just so that they know that they would be able to sell, let's say, their wheat at a given price if the price of wheat tanks, let's say, in a year from now. You can use them to mitigate risk, or in this case, if you're speculating the market's going to go down, you can use them to reward yourself for speculation. So it's just important to note that this is an extremely risky strategy for advanced investors. Options are extremely complex when you get into, the transaction cost and the market value versus the time value of your options, and really pricing them and making sure you use them appropriately, either to reward yourself for speculation or mitigate your risk. Their payouts can often be complex to calculate. This is something that I wouldn't recommend for beginner investors. These are high risk financial instruments which require experience to execute properly. Now, there's tons of different strategies. A lot of them are fairly advanced. We won't go into all of them. I'll put a few of them up on the screen, but just to name a few here, you have the married put, you you have the bull call spread, the bear put spread. You also have the protective collar, the long straddle, the long strangle, the butterfly spread, the iron condor, and the iron butterfly. Again, these are extremely complex securities, something that I'm not going to recommend to the beginner investor. If you are a seasoned investor who has been investing, let's say, for 5 to 10 plus years, this is something that you should definitely look at to profit in these desperate times. Okay, let's go ahead on to the second strategy. Okay, the second strategy is short selling, and this is the complete opposite of buying a stock or going long on a stock. When you're going long on a stock, you are betting on it to appreciate in price, and the majority of the market is actually long the market. This is a very traditional way of investing. Now, short selling is kind of counterintuitive, but you're doing the exact opposite. So since the market is a zero-sum game, meaning when long investors lose money, it's going to short sellers, and when short sellers lose money, it's going to long investors. When you're short selling, you're betting on the stock to depreciate. The risk that is associated with short selling is that your losses can technically be unlimited. Okay? If we use just a basic example, when you're buying a stock or you're short selling a stock for $5 and it goes up to $10, you've lost your entire principal. But in theory, that stock can also appreciate to $15. Okay, so now you've lost your principal 2 times over. So in theory, your losses can be unlimited, but what this does is allow you to benefit from a correctional market, benefit from a bear market, and it increases the efficiency of the market. Wealth is directly transferred between short and long sellers and vice versa. So again, this is an option that you can take. Not all brokers have the ability to short sell. So if you're trading, let's say in Canada, you'd have to look somewhere as Interactive Brokers, or you'd have to look at Questrade or something along those lines. You can't always get these financial instruments at your traditional brokers. Same with derivatives. That's the second option. A very famous example of this option is the movie The Big Short. Okay, so Christian Bale, Brad Pitt, what's that guy's name from The Office? Michael Scott. I forget his name in real life. Anyways, that movie, a great example of how you can short sell the market and make a huge profit. Let's go ahead and move on to the third strategy. Okay, the third strategy is to dollar cost average. What dollar cost averaging is taking a fixed amount of money and investing it over a specified period of time. Okay, so let's say, we're going through some desperate times right now, some times of volatility like we currently are seeing in the markets, but you know that you want to be long Tesla or you want to be long Apple. Okay, you have $1,000 and maybe let's say you have $10,000. You have $10,000 and over the next year, you want to reduce or limit your exposure to volatility. So what you do is you take predefined points and you're going to invest into that company every month on the 1st, or every month on the 15th, or every quarter on the 15th, something along those lines. And what that does is it usually normalizes your average purchase price. Seasoned investors, what they'll do is they will actually always try to reduce their average purchase price. So in times of need now, when we see stocks down 20% from their all-time highs, they might take a large sum of cash, which they were just holding, and throw it into a stock which they are bullish on long term, but has depreciated quite a significant amount in the near term. So what that does is it reduces their average purchase price so that it doesn't need to appreciate as far for the investor to make gains on that stock. Let's go ahead and move on to the fourth strategy. Okay, so the fourth strategy is to change your portfolio weights. Now, typically when you're investing, your portfolio manager, your financial advisor should assign you weights to all 11 financial sectors. So for those of you who are not familiar with the financial sectors, you have energy, you have basic materials, you have industrials, consumer discretionary, which is non-essential goods, consumer staples, which are essential goods. Then you have healthcare, financials, information technology, communications, utilities, and real estate. And if you're maybe part of the younger generation, maybe you might want to also include cryptocurrency as the 12th financial sector, but currently there's officially only 11. Okay, so if you look at previous financial crises, we go back to 2008. What would have been a smart move to do during 2008? Short the entire market. No. Specifically, you could have shorted financials. There were some companies that went bankrupt, like Lehman Brothers in 2008, and that might have been the play there. I know the broader market as a whole was down almost over 50% in a matter of a couple of years, but there are specific sectors which perform better in times of crises. During 2002, the crash of the tech bubble crash, a prime strategy might have been to long or to short, information technology. As you kind of determine what's going on in the world right now, right now we have a global health pandemic. You might want to long healthcare stocks, for instance, might be an option. But some sectors that are typically resilient in times of recession are utilities, healthcare, and consumer staples. Consumer staples, obviously, you see everybody running out to the grocery store, emptying the shelves in your local grocery stores. Utilities as well, because people are going to be at home using electricity, etc., etc. So each recession or each major crash, you need to kind of be diligent in assessing the current market conditions based on the black swan event that's occurring, and just allocate your portfolio based on what's going on, okay? So, for instance, I would be longing healthcare stocks in a global pandemic. And I would certainly be 0% in oil based on the price war going on right now. Okay, so let's go ahead and move on to the fifth step. This last one is kind of inevitable, if you will. Investors such as Warren Buffett have made this one famous. It's shown that the stock market over time is always a great investment. These times of desperation always do pass. And actually, in times of desperation, this is the best time to get the best deal on stocks if your intention is to go long on companies. Warren Buffett has kind of made this famous by using dollar cost averaging, by using value investing to pick up stocks that are extremely cheap during recessions, during market crashes. We saw him recently in the past 2 weeks. He actually doubled down and bought more stock in his airline companies, which he owns. So for those of you who don't know, there's all these, well, everybody clearly knows, there's all these international travel bans going on right now. So which sectors are going to take a massive hit? You're going to see cruise lines get destroyed. You're going to see airlines get destroyed. So just important to note that maybe these companies are trading below their intrinsic value right now. There's a lot of other factors other than just the price, such as like share buybacks and how Boeing has bought back like 96% of their shares in the last 10 years. Like, probably want to stay away from that stock. I'm not going to get into share buybacks and corporate debt in this video, but holding on, being a perma bull has always shown to be a good strategy in the long term. If you're a little more impatient, maybe you want to look more towards these two strategies at the top, using options, using short selling as a manner to profit from a market crash and increase the efficiency of that market. Okay, so those are the 5 strategies I have for you guys. If you have any questions for me, put them down below in the comments. I hope you guys did enjoy this video. If you did, don't forget to smash the like button. Subscribe to the channel if you haven't already. Share the video with a friend if you learned something, and I will see you guys in the next video. Peace out, guys.